Good afternoon, everyone. Thank you so much for being here. So we were in for a real treat this afternoon. I'm Tom Brigandy, and I have the privilege of leading this panel. I'm a managing director at RisCura USA, which is a division of RisCura, which is the largest emerging market domiciled investment consultant. We advise on about $200 billion of pension fund assets. We're headquartered in Cape Town, South Africa. And of our assets under advisory, about $70 billion is invested here with US managers in the States. And we also have about $9 billion in our OCIO business. So at this time, I'd like to pass it over to my panelists to each introduce themselves, and then we'll jump into the discussion. So Charles, maybe you should start.
Thank you. Charles Cherington, managing partner at ARA Partners. We are an industrial decarbonization private equity firm, 3 verticals. We are investing in private equity out of a $3 billion Fund 3, infrastructure out of a $550 million Fund 1, and we're raising a $1.5 billion energy decarb fund. So the common theme is that we know how to build plants. When you think about decarbonization, you're going to have to build new plants or retrofit old ones. I'm not building the plants. You wouldn't want me anywhere near them. We have people who know how to do that go along with the regular way private equity people like myself. And we invest in North America and Europe.
My name is Jordan Marye. I run Trace Capital Management. We're a relatively new energy private equity firm that was spun out of a legacy firm called Denham Capital Management 3 years ago. We manage about $1.6 billion today across 2 flagship funds, and we do 2 things in the traditional energy world. We build and own and improve infrastructure, mostly natural gas infrastructure throughout the country, and then we own and build and improve resource, which is essentially oil and gas fields. So we buy fields, we make them better, we drill wells.
Hi, I'm John Hirschtritt. I'm from GCM Grosvenor. We're an $80 billion institutional asset manager working on behalf of mainly pensions, sovereigns, corporates, and a growing retail practice. We only participate in alternatives, so private equity, infrastructure, real estate, private credit, as well as we have a hedge fund to fund business. And I lead our sustainable and impact investing practice. So working with institutions around the world who are interested in producing returns first programs, but have thematic, mission aligned or sustainable themes to them.
Thank you so much, all. So John, kicking us off from an LP perspective, would really love to hear your thoughts about the multi-asset class opportunity from both an energy transition and a traditional energy perspective.
Yeah, so energy is a super interesting place. As you'll hear on this panel, I think we almost have 2 people on opposite ends of the spectrum, but it really speaks to the wide opportunity set that exists. So Charles and I obviously sit much closer to what I'll call the newer trend, which is around energy transition, sustainability, driven by a lot of the supply-demand dynamics that are going on in the market today based on the world's kind of need for decarbonization and net zero and things of that ilk. That's moved a lot of capital into the energy space and created a lot of opportunities. I think at the same time, Grosvenor, as well as others, and where Jordan probably plays more, is there's still a lot of energy needed in more traditional angles of energy. And this transition is not happening overnight. And so I think we are seeing just a very broadening opportunity set. And in our world, we're seeing it not only in terms of the types of deals, but also the asset classes that they play in. So we are seeing private credit strategies pop up around energy transition. We are seeing private equity strategies like ARA, which we are an LP into, and we can talk about. Infrastructure is obviously where this all started, and we can talk more about that. So it's really a broadening opportunity set, and I'd say that being an energy investor today, you now have to wear a lot of different hats because there are a lot of what some people would deem legacy opportunities as well as newer opportunities, and you can make good returns on both.
Excellent. Thank you so much, John. Jordan, so 80% of the world's energy comes from fossil fuels. Energy demand growth and decarbonization goals can often be at odds. How does Trace think through the opportunity and challenges of the future energy landscape? And if that's one part of the question, and the second part is, what role does natural gas and oil have to play?
So the big mega trend of the next 2 decades is going to be energy demand expansion. Half the world lives on a tiny fraction of all the energy that we individually consume and enjoy in our natural lives every day. And that is going to come from all sources. It's going to come from existing coal resource base, natural gas, oil, hopefully in the coming decades, nuclear, and all the sustainable strategies that are well known, like solar, probably most of all, wind, those sorts of things. Natural gas is going to drive the electrification of the world, the growth of the electrification of the world, and that's a place that we're really excited about. The United States is now the Saudi Arabia of gas. 10 years ago, we exported 3% of our natural gas to the world. Today, it's more like 20. The next 7 years, it'll be more like 40% of the natural gas that is produced in this country and on this continent will go to serve the world's growing energy needs. That means that the resources that the United States and Canada owns is a very exciting place to invest. You have to be very technically sophisticated. Resource assets do not dispatch in a linear fashion, and so it's a highly technical undertaking that we've built an entire process and team around. But more even so than resources, infrastructure to connect those resources to where they are exported and to where they are used is going to be a huge growth opportunity over the next 10 years. And we're building natural gas pipelines every day to serve that need. And that is before anyone has said anything about artificial intelligence. Just LNG alone will be a huge demand mover in the natural gas market. And we think that that's an incredible mega trend to play over the next decade plus.
Thank you so much. Charles, so we just heard from Jordan that fossil fuels, they're going to be around for the long haul in the U.S. given this rising power demand, driven, of course, by AI data centers, broader electrification trends. How do we decarbonize the power sector given its heavy reliance on fossil fuels?
Sure. Well, actually, I think we may be less far apart in a way than one might think. So our view is this. I mean, you can look at something called eSAF, which is sustainable aviation fuel derived from wind power, put through electrolyzers to make hydrogen, et cetera. It's lovely. It's also about $10,000 a ton or $33 a gallon. It's never going to work commercially when Jet A sells for $2 a gallon. So the question is, what's the cheapest way to decarbonize today? You can go to a natural gas plant today, a natural gas power plant, and you can put something called an amine unit on the back end, capture and concentrate the CO2, put it in the ground, and that would be about 1.3% of the cost per ton of doing eSAF. So, it turns out that fossil fuels aren't really the enemy. It's the negative externalities or the emissions that are associated with them that are the problem. And as an investor in decarbonization, a dwindling minority of our investors will say, we won't touch anything with fossil fuels. And our response to that is, well, that's great, because these natural gas power plants in the US, for instance, where demand is growing and where it's very hard to build new assets, they're not going away. They're not going to go away for 40 years and maybe even longer than that. We're really waiting for sort of nuclear utopia to come and save us. And for a whole bunch of reasons we're all familiar with, that's going to take a lot longer than one might expect. You can build a new natural gas power plant for $1,600 a kilowatt right now. That's too expensive. There are very few markets where that price signal works. The most recent nuclear power plant was $18,000 a kilowatt. It's crazy. Until the nuclear regulatory code is fixed, et cetera, it's simply not an investable asset class. So you have two choices. You can turn your nose up at fossil fuels and at natural gas power plants and say, you know what, we don't invest in them, let's just let them pollute. We'd rather go invest in that stuff that's almost 100 times more expensive that sounds really cool at cocktail parties. Meaning, for instance, eSAF or direct air capture, $1,000 a ton. I'll take $130 a ton on the back end of a natural gas power plant. And when you're doing that, you're attacking a concentrated source of emissions. You are doing it at a small fraction of the cost, and you're doing it where the price signal is there today. There are plants today where you can go do that and make money. Everything we do has to make money. If we can't generate attractive returns, there's no point in decarbonizing. So to the contrary, I actually think the conventional industrial and energy sector represents in a lot of cases the cheapest, quickest way to decarbonize. That sort of turns the thinking about climate, et cetera, on its head. But I think consciousness is changing pretty quickly in that regard.
Thank you so much, Charles. So, Jonathan, we heard two managers and their perspective, and from an LP perspective that has a pretty big focus on energy transition. There are many energy transition strategies across industries and asset classes. Which ones are you finding most compelling today?
Yes, so I think that what Charles just said is a great example. I think we are looking for truly differentiated strategies where sustainability is woven into value creation and P&L. At the end of the day, I'm a big believer that sustainable investing will only become scalable and attract institutional capital if it can produce returns that are in line with what our traditional asset classes are doing. And so I think that both what Charles said and my belief is that if we can find differentiated, creative ways to play in these asset classes like private equity, like infrastructure, like credit, find unique kind of cash flow streams or opportunity sets that can be monetized, produce strong returns, but also have secondary or ancillary benefits towards the environment or other sustainable strategies. I think that is the future, basically. And in full disclosure, as I said, we are an LP in ARA, and I think what Charles and team have done so well is that they've made it all about the returns. They can walk into a red state pension and they can sell that they are a differentiated private equity strategy that is taking traditional industrial private equity, mixing that with the trends and the supply-demand dynamics that are being created around sustainability and net zero and some of the decarbonization trends, and really look and sound different and drive returns and strategies that are different. And I think that's the spirit of what we're looking for. One additional example is we recently invested in a credit manager who has deep expertise in taking residential solar loans, packaging them together, securitizing them in the asset-backed security market, and creating really attractive returns off of that. It almost looks like residential mortgage-backed security. It's people who have 750 plus FICO scores. They're driving a 15 to 20% private credit return stream off of it. And the ABS market is basically offering a significant premium to those assets and borrowers than if they were just in a traditional RMBS market, because it's something newer and different. And so again, that's a sustainable strategy. It's leading towards the increase of residential solar units out in the US, but it's also driving returns because they're doing something different, new in the market, and they're getting kind of an alpha premium off of it. So two examples of, again, how we're really looking for returns first strategies that also are deeply tied and woven into sustainable themes.
Thank you so much for sharing that, John. And really, if you could also just go one layer deeper in terms of your institutional clients, the sovereign wealth funds, the pension funds, how are they viewing it in terms of customizing their mandate with you to go and find those innovative opportunities?
Yeah, I think that institutions around the world, particularly based on geography, but also types, are at very different stages of their evolution around seeing sustainability as an alpha generating part of their portfolio. If you go to places like Europe, it is very advanced. You see a lot of dedicated carve-outs for things like climate opportunities, where it is dedicated capital for strategies like this. And they are convinced that there is a return play and that there's also other environmental benefits that they are looking to take advantage of. I think if you come to a place like the US, we obviously are earlier in that evolution. On the coasts, particularly in New York, California, we have some very advanced institutions. Look at the CalPERS, the CalSTRS, New York City, New York Common. They all are talking a lot about these types of things. The reality is there's still many institutions, particularly in the US, who aren't sold. There isn't enough track record, there isn't enough history to prove out that there's enough strategies that can drive the returns and be benchmarked against traditional private equity, traditional infrastructure, traditional credit. So I think returns, again, will ultimately determine that. For the programs that are more advanced or those that are looking to develop, our strategy works very well because 71% of our business is custom separate accounts. So we don't actually have to force upon definitions or tell you as an institution what to invest in. You can kind of come to us and tell us where you are in that journey of getting comfortable, how much you want to lean in, where you see the opportunity sets, and partner with us to develop something that's additive to your portfolio. And I'll end with an example. We have a Swiss pension. The board basically adopted a net zero plan. They asked the pension to start thinking about how to incorporate that into their traditional pension investing. We worked with them for over a year to develop a custom climate solution in infrastructure. So we developed, looking at third-party frameworks, but also based on what they were looking for, three-pronged definition of what types of assets could go into this program. And so we're launching basically a climate solution with them that's really customized and measures and searches for opportunities that fit that definition. And so I think that customization is a real asset in our world, as people are at very different life cycles, you know, of where they are comfortable with sustainable investing.
Thank you so much, John. Charles, so we just heard John mention about that customization from the LP base. So how does ARA think about differentiating itself as investors consider their allocations to these green and decarbonization trends?
Sure. Well, I think, first of all, we have three strategies that serve very different objectives. So if you look at private equity, we do two kinds of deals. We do buyouts of companies providing products and services to the revolution, you know, to kind of decarbonization. That could be something as unique as an insurance company. We should talk, by the way, because we can actually double the returns with an insurance product replacing a power purchase agreement for a solar asset. We can do that for wind power as well. So it just turns out, without getting too technical, it's a way to fundamentally reprice the returns you can get in the arena of solar. That's an example of a buyout providing a service to the decarb movement. We have companies that provide products as well. So companies that manufacture, for instance, permanent magnets with rare earth metals in them. We're in kind of high demand right now, given everything that's going on with the trade war with China. Those go into electric motors. That's a product that's supporting another decarbonization platform, i.e. electric vehicles. On the infrastructure side, it's pretty straightforward. We invest in companies that transport, process, and store green molecules. That can be everything from terminals to transloading facilities for biofuels, to RNG, et cetera. So it's a very focused strategy, contracted cash flows giving you high single-digit yields with upside from building multiple copies of those cash flowing assets. And in energy decarb, this is our most recent fund we're in the market with now. We are buying thermal power plants, natural gas power plants, with an eye towards decarbonizing them with those economics I described previously. Ethanol plants. Ethanol is, you can print money today with 45Q, the tax credit for storing CO2 in the ground. And by the way, with all of the chaos going on in the Trump administration, the Inflation Reduction Act is largely unchanged. If you're in the solar world, that's obviously not true. The DOE loan program is going to get, you know, pretty severely pared back, but they didn't really do that much. But in terms of the tax credits for sequestering CO2, producing green fuels, constructing certain types of green assets, really business as usual. That's good because you can sequester the 99.5% CO2 that comes out of a smokestack at an ethanol plant. Costs you about $40 a ton, you get paid $85. It's a cash register. And by the way, anywhere you see a smokestack with 99.5% CO2, it's basically $20 bills floating in the air. Think of ammonia plants, think of oil refineries, think of steam methane reformers, think of biorefineries. Those are all places where you don't have to do what you do at a natural gas power plant, where you got to concentrate that 5% CO2 coming out of the stack to 99, then put it in the ground. Well, that's capital intensive. It's still much, much cheaper than making sustainable aviation fuel or doing direct air capture, et cetera. So in that arena, you're getting double-digit yields for the assets that we own, private equity-like returns, and you're getting decarbonization. Now with natural gas power, you got to have the right price signal. So today we can make $105 a ton to put it in the ground, but we need 135. So there are ways to solve that. You make the capture cheaper, you raise the amount you get per ton. That gap closes, by the way, and I think as far as ARA as an entire platform is concerned, decarbonizing thermal power is the biggest opportunity we have to save hundreds and hundreds of millions of tons while making money. So you can sort of pick your poison, right? We can do the private equity deals where we're either doing the buyouts that I mentioned, or we're building plants to make sustainable aviation fuel, advanced biomethanol, green diesel, green gasoline, critical materials. Or you can go to infrastructure, have a set of contracted cash flows, or you can do energy decarb where you've got high yield and you've got the opportunity to earn private equity returns. It just depends on your flavor. We have a higher bar for decarb and private equity, and the reason that it's higher than energy is energy has got to wait for that price signal in power. The price signal's there for ethanol, it's not yet there for power.
Thank you so much, Charles. Jordan, circling back to the traditional energy perspective, given the growing demand for the secure and low-cost energy, how are U.S. energy exporters shaping midstream investment themes when you think of Cheniere and other LNG exporters?
Yeah, so I mentioned it earlier, and I'll use this opportunity to talk about kind of what we do and how we do it. So 10 years ago, we exported 3 BCF a day off this continent, if you don't include Mexican exports. Last week, it was 17 BCF, and on any given day, it can be as much as 19 BCF a day. So a huge increase in energy export from this continent. And so our job in response to that, and to sort of take advantage of, again, the mega trend of energy demand globally growing and the U.S. providing the energy raw materials to meet that demand, we're trying to own assets and make them better to serve those demand centers. So what does that mean? We are building a pipeline right now that goes from northern Louisiana to southern Louisiana, which is the last current uncongested natural gas corridor on the Gulf Coast. Typically, gas used to go from West Texas to the Louisiana Gulf Coast along the I-10 corridor. Today, that is a completely congested corridor, and so today we're building a $1.5 billion project to move gas from northern Louisiana, where it's produced, and also routed from places like West Texas and South Texas down into Lake Charles, where a lot of the LNG demand is being built right now. That's a business where we're essentially underwriting a new pipeline build through take-or-pay investment-grade contracts of base customers, and we sign up, call it 40% of the capacity of a pipe at time zero with those type of contracts. That pays back the capital of the whole pipe. And then over time, we monetize the empty space of that pipe, the remaining 60%. And it can be really dramatic, real returns, private equity style, multiple on money returns at very low risk, all in service of getting the gas off the continent to go sell to places like Europe, to Asia, to Latin America, and elsewhere. On the upstream resource side, gas fields and oil fields continue to meet the demand of energy in this country and elsewhere. And this asset class, energy private equity, over the last 20 years, has been a boom-bust asset class. It's been portfolios that had high internal dispersions of grand slams and zeros. And we founded Trace and have built the investment process at Trace to actually move this asset class in its current mature states to a more of an industrial private equity posture, whereby we are owning resource assets, fields, wells, pipelines, and we are advancing their improvement quarter over quarter, day over day. And there's a commodity overprint beta to what we do, but it's more like 20-25% of the value in our portfolios. Most of the value in our portfolio is through risk management and operational improvement, moving resources and infrastructure assets along their growth life cycle. And if we do that successfully, which we have done over the last 5 and 6 years, we haven't had a problem in the last 5 or 6 years, we can create portfolios that are really powerful from a return standpoint, 3x gross, private equity fund type returns.
And who are the off-takers for that end gas that?
It runs the gamut, but it is multinational energy companies, large Japanese and Korean trading houses, governments. The pipe that I just referenced in Louisiana is the first pipe underwritten 100% at FID. We call that a final investment decision by demand pull contracts. Historically, when you built a pipeline in this country, shippers, people who own the commodity at the field level, were shipping it from A to B, and they would sign up for the space of your pipe initially. Today, we're seeing such demand from international companies that are trying to export U.S. commodities, particularly natural gas, off this continent, that they're signing up for the space of our pipes before the folks that actually own the resource do.
Excellent. Thank you so much. Charles, circling back to you at a higher level, what does the energy landscape in your mind look like in 20 years from now?
So to replace a natural gas power plant with solar, you have to build 6 times the capacity of that plant in solar and batteries, which has a capital cost of about 6 times of the plant. So if you just think about replacing the power infrastructure in this country with solar and wind, we know a few things. Look, I would love as a citizen if solar, wind, and nuclear took over tomorrow, right? Because emissions are an existential threat to our species and a whole bunch of other species before ours along the way. So it's a very grave problem, but you have to kind of face the reality, which is, just to give you one example, we needed about 250,000 miles of transmission in the US to hook up renewable power to kind of population centers. In 2023, we built 50. And if you think that was a bad year, 2022 was much better, it was 250. We can't build anything in this country. And the sort of permit reform, et cetera, that we all hope for is a much heavier lift and requires a lot more political will than either major political party seems to be able to muster. So if you accept that premise, and you also accept the premise that even building a thermal power plant today doesn't have the price signal to make money for investors other than a small semicircle outside of Washington, D.C., you are stuck with a conventional power sector that's not going to change that much. You can't just wave a magic wand and change the way nuclear power is priced in the U.S. It shouldn't be that expensive, but it is. You're going to have wholesale regulatory change. You're going to have to deal with the fact that you have 3,300 utilities in the United States. They can't agree on anything. When you do basically a grid study to put a new substantial power plant in, you've got the feds, you've got states, you've got towns, you've got environmental groups, you've got probably multiple utilities. It's just about impossible. So we have to accept the fact that what we've got today isn't going away in any fundamental way. Yes, coal will continue to get retired. That probably gets replaced with natural gas turbines. So it comes back to the fact that if you own those assets, you've got something quite interesting, particularly if you can get them at the right price, number one. And number two, the commitment to decarbonize, if the will is there, you're going to have to decarbonize what's in place rather than building an alternative utopia to replace it at 10 times the cost per kilowatt.
Thank you so much. So with less than 2 minutes left, I have a final question for John. So given the input of AI is all this power, how is your firm leveraging AI in your day-to-day work as an LP?
Well, I can tell you first and foremost how I'm personally using it.
Yes, please.
About a year ago, I don't think of myself as an early technology adopter. Today, we have a internal firm, ChatGPT, that basically is secure, and I basically flow almost every email through it. Not because I'm asking it to write every email, but to basically condense, check, look for data. Rather than going to Google, I'm often going to ChatGPT and asking these questions. So from a personal perspective, it is revolutionizing my team, how we work, how we think. We do a lot of requests for proposals, things of that ilk. When there's word limits or we need to get tighter in how we say things, we're using ChatGPT. So that being said, we also see the investment opportunity of it. So in our infrastructure practice, we are a very large owner of a data center platform. And I would say 5, maybe 7 years ago, data centers were all like a real estate play. today, the only thing people talk about with data centers is there enough energy to support the data center to keep it running? And so to both Jordan and Charles's points, like the amount of energy demand that is just coming into the system and on the grid from lots of different places, but particularly AI, in itself is creating a whole new energy investing opportunity set. So I think we're seeing it in a lot of different ways throughout the ecosystem, both internally, professionally, but also as an investing organization.
Thank you so much. And on that note, please join me in thanking this illustrious panel for sharing their insights.